Welcome back to Smart Money and Mind channel, where we roast your wallet, so your future self can thank you. Let me ask you something real quick. What if I told you that while most investors are arguing online, the smart money, hedge funds, institutions, and billion-dollar managers have already made their moves? Not guesses, not vibes, actual capital, real money, big conviction. Today, I'm breaking down what smart money is quietly doing right now, what they're buying, what they're trimming, and, most importantly, what this means for everyday investors like us. Stay with me, because the biggest mistake retail investors make is reacting after the smart money already moved. What smart money really means. First, quick reset. When people say smart money, they're not talking about magical geniuses. They mean pension funds, hedge funds, asset managers like BlackRock and Vanguard, billion-dollar portfolios filing SEC 13F reports. These investors, they move slow. They buy in size. They think in years, not days. And every quarter they're legally required to show us their cards. So today, we're reading the table. Big call. Number 1. Smart money is still in tech, but more selective. 143 though. Let's clear this up. No, smart money did not abandon tech. But yes, they stopped chasing everything. What we're seeing instead, continued exposure to AI infrastructure chips, data, cloud, and cash flow positive tech, less love for hype-only growth. Translation. Smart money isn't saying tech is dead. They're saying prove it. They want real earnings, real margins, real cash flow, not trust me bro PowerPoints. Big call. Number 2. Quiet rotation into cash flow and defensive plays. 3 Botster 430. Here's something retail investors often miss. While headlines scream all in or all out, smart money does something boring. And boring makes money. We're seeing increased exposure to dividend-paying stocks, businesses with predictable cash flow, companies that survive any economy. Why? Because smart money knows something. Markets don't crash because of fear, they crash because of liquidity. And cash flow businesses create their own liquidity. This part is critical. Smart money is not panic selling. They're trimming overweight positions, locking in gains, rebalancing risk. This isn't bearish behavior, it's professional behavior. Retail investors ask, should I sell everything? Smart money asks, am I overexposed? Huge difference. This is why they survive every cycle, and why panic traders disappear after one bad year. Big call. Number 4. Diversification is back. 6 Bout 730. For a while, diversification was mocked. Why diversify when tech always wins? Well, smart money remembers history. Right now we're seeing international exposure increasing, real assets creeping back, and inflation-resistant investments gaining attention. Not because they're scared, but because they're prepared. Smart money doesn't need to predict the future, they just need to survive it. Let's be very clear. Smart money is not all in on meme stocks, chasing social media hype, YOLOing weekly options. That stuff creates great screenshots and terrible long-term results. Smart money wins quietly, retail loses loudly. Here's the takeaway, and this matters. You don't need to copy smart money stock for stock. What you should copy is their behavior. Think long-term, favor cash flow, avoid emotional decisions, rebalance instead of panic. The goal isn't to beat billion-dollar funds. The goal is to stop fighting them. If you found this helpful, hit the like button. It helps more than you think. Subscribe to Smart Money and Mind if you want calm, data-driven investing without the hype. And remember, smart money doesn't scream. It moves quietly. I'll see you in the next one.